The geopolitical shocks coming out of overseas conflicts are sending the broader markets into a tailspin. Suddenly, the mega-cap tech giants that everyone thought were invincible are showing massive global vulnerabilities. For late starters trying to catch up, panic selling right now will destroy your retirement plan. We need a different approach. Welcome back to FactorDad and part 2 of our Factor 4 portfolio series. Today, we are opening up the engine room of my $1.5 million portfolio to look at the ultimate domestic growth accelerator, AVUV, the Avantis U.S. Small Cap Value ETF. Right now, this is the most important puzzle piece you can own. In my Fired My Advisor video, I showed you my foundation, Fidelity's Zero-Fee Total Market Fund, FZROX. It is a fantastic fund, but because it is weighted by market capitalization, it is heavily concentrated in the massive, multinational companies taking the biggest hits from global instability. We need an edge to offset that risk. So what exactly is AVUV? It is not a broad index fund that blindly buys everything. It is a highly targeted exchange-traded fund designed to surgically capture specific risk premiums. Instead of chasing international tech hype, AVUV hunts relentlessly for three things: size, value, and profitability. Let's start with the size premium. A $2 trillion multinational company has a massive target on its back when global trade is disrupted. But small-cap companies? They are agile. They adapt quickly to local conditions. The academic data shows that over long periods, these smaller companies provide a premium, a higher expected return. Next is the value premium. Growth stocks are priced based on future hype and perfect global conditions. Value stocks are priced based on the cold, hard fundamentals of what the company is actually worth today. When we buy value, we are essentially buying $1 of actual, tangible assets for 80 cents. But here is the danger. If you just buy a generic small-cap value index, you end up buying a lot of garbage. You buy zombie companies that are cheap because they are failing. This is the Avantis edge. AVUV mathematically filters out the junk, leaving you with a portfolio of deeply discounted, highly profitable cash flow engines. And this is why I call AVUV the Wartime Bunker. In times of global panic and conflict, tech hype fades rapidly, PE ratios compress. The only things that matter to the market are cold, hard cash flow and current profitability. AVUV is mathematically built from the ground up to weather these exact storms. It acts as a domestic shield. The mega-cap tech companies rely on incredibly fragile overseas supply chains and international microchip manufacturing. AVUV companies do not. They rely heavily on the U.S. domestic economy. By holding AVUV, you are intentionally insulating a chunk of your wealth from international trade disruptions. When you look under the hood of AVUV, you won't find overvalued software startups. You will find that nearly 27% of the fund is in financials, about 20% is in industrials, and 16% is in consumer discretionary. You are massively diversifying your money away from the crosshairs of global conflict. You are buying real businesses. You aren't just holding paper tickers. You own pieces of regional banks, heavy manufacturers, local builders, and material suppliers. You own the absolute engine room of the American economy. These companies make real things, and more importantly, they print real profits regardless of what happens overseas. Why is this so crucial for late starters? Because we have a catch-up problem. We need aggressive growth to close the gap in our retirement accounts, but we absolutely cannot afford the concentration risk of holding nothing but top-heavy tech stocks right now. AVUV provides that high-octane growth potential through deep domestic diversification. It acts as a geopolitical shock absorber. Historically, AVUV has a lower correlation to mega-cap growth stocks. When geopolitical news flashes across the screen and crashes the S&P 500, AVUV often zigs while the broader market zags. It is a vital shield against sequence of returns risk when the world gets crazy. What does this highly targeted, actively managed factor screening cost? The expense ratio for AVUV is a remarkably low 0.25%. Compared to an advisor taking 1% of your entire balance while your portfolio bleeds, Avantis is giving you institutional-grade factor exposure for pennies on the dollar. And because AVUV specifically targets highly profitable value companies, it throws off cash. These are mature businesses that often return cash to their shareholders. AVUV provides a solid, reliable dividend yield. During a market downturn, you can automatically reinvest those dividends to buy even more shares at a deep discount. But at FactorDad, we deal in reality. I will not sit here and tell you this is a magic bullet. The first risk is extreme volatility. Geopolitical events make small companies swing wildly in price. You are going to experience massive green days and brutal, stomach-churning red days. You must have the stomach for the roller coaster. The second risk is tracking error. Because you look so different from the S&P 500, there will be stretches where the broad market beats your AVUV holdings. When the conflict ends and tech rebounds, your friends might brag about their gains while you trail. You have to trust the academic math, not the water cooler hype. To survive those risks, I implement a strict FactorDad rule, the 10-year minimum. Factor premiums are incredibly reliable over long horizons, but they are unpredictable in the short term. Do not buy a single share of AVUV if you need that money in 3 to 5 years. This is a decade-long wealth-building bunker. In my personal $1.55 million strategy, AVUV makes up exactly 16% of the total allocation. It is the perfect counterbalance to my broad market index funds. Next week, we are tying it all together and looking at the foundation, FZROX. Hit the like button, stay the course, and I'll see you in the next one.